Hey everybody, so even though the stock market is still pretty close to record highs, doesn't mean there aren't fun places to put your money to work right now. But we're going to get into a couple of our favorites, Tyler and I. Before we do, take a minute and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing. Once again, that is fool.com/Frankel. So we're going to be talking about stocks that are still down 50% or more from their 52-week high that we are taking a closer look at, not necessarily that we're ready to buy. So I will go ahead and kick this off. One that, and I know Tyler was kind of impressed with the numbers with this company as well this past quarter. This is Opendoor, ticker symbol OPEN. Now, I've been relatively bearish on iBuyers since the real estate market turned. It was a business that was set up to do really well in a low interest rate environment, or at least a relatively stable interest rate environment. If interest rates had ticked up slowly in 2022, I don't think we would have seen the carnage in the iBuying business like we saw when interest rates went, from 3% to 7% over the course of a year in the mortgage market. So I've been pretty bearish since that move happened. And my general thought was that iBuying wasn't going to experience any significant turnaround as long as interest rates stayed elevated. And Opendoor's recent results, I have to admit, surprised me. That's not really been the case. So Opendoor bought 17% more homes in the fourth quarter than they did a year ago. That's not what's that impressive. Any company that has the capital can go out and buy a couple thousand homes. But their margins are improving at the same time. The contribution margin is up to 3.4%, which might not sound like a lot, but remember, we're talking about thousands of houses here. That's a lot of money. And it's not just that they produced a 3.4% contribution margin, it's that they were expecting to produce a 1.9 to 2.9% range. So they're definitely beating their own expectations here. Gross margins are about 8.3%, which for an iBuyer, remember, you're talking houses. These aren't going to be giant margins. That's a pretty solid margin. They're losing less money than they expected to. On an adjusted basis, they lost $69 million in the quarter, better than they guided for. They're spending less on ads. They have a lot of cash on the balance sheet, but not a ton. They're doing a good job of getting rid of debt. At the end of 2022, they had about $4 billion of debt on the balance sheet. That's down to about $2.5 billion now. Still a lot, but moving in the right direction. They're targeting a contribution margin of 5 to 7% per house, which they're getting 5.1% from the new book, excluding the legacy houses that they admittedly overpaid for, back in the kind of housing boom. They're not expecting positive income this year, but they definitely see a path to get there, and they're showing it to investors right now. And if they're doing this well when interest rates are steadily bad for an iBuying business, I have to think that things could get a lot better if interest rates do start to fall. I love how they're leaning into the partnerships that they've formed, particularly with Zillow. Their Zillow partnership is live in 45 markets where you can easily get an Opendoor offer directly through Zillow's platform. Opendoor announced that their acquisitions through their partnerships are up by 140% since the start of 2023 when they really started rolling out the Zillow partnership. But they also have partnerships with Redfin, with Realtor.com, with home builders like Lennar, with eXp Realty, and others. So I really like that. I hope they continue to lean into that. And like I said, I'm not quite ready to buy yet, but this one's definitely got my attention with its latest results. I'll be watching it closely throughout 2024. Tyler, what are you looking at?
Yeah, so this is a company that probably you haven't heard of the company itself, but you've certainly heard of the products that it makes. The company is Helen of Troy. Now, this is a business that is it's a consumer goods conglomerate, I guess, if you will. Some of the things that it's most famous for are Vicks. So anybody that takes NyQuil or Vicks Vapor Rub or anything like that, they own the brand, basically the branding associated with that, and anything that is like a hair care product. So on the mechanical side, so hair dryers, curlers, straighteners, things like that, they basically build a majority of those on like branded deals for other companies. So it builds all the hair dryers and straighteners for Revlon and Drybar and Hot Tools and several other different brands. And basically, they're all made by the same company, which is Helen of Troy. On top of that, they make bronze shaving products as well as pure water filters. The clothing line Osprey, there's a lot of like, I guess we call them Tupperware competitors that you get at Target called OXO or OXO. I don't know how they actually pronounce it. And then the water bottle company Hydro Flask. So it's this kind of strange amalgamation of consumer products. And honestly, a lot of the acquisitions that it made didn't necessarily make a lot of sense. They kind of saw themselves as this consumer branding roll up company. If we can bring in new brands, we're going to, we can leverage them and use our distribution channels and all of that stuff. And honestly, it didn't quite work as well as expected. Probably the rates of return on some of those have not been as expected. And there was a little bit of you could call it a COVID bump, because look, if you made VIX during 2020, 2021, I'm sure you sold a lot of that stuff. So what has been going on is basically the stock has been hammered over the past 3 years. It's down 58%. From its highs, and right now it trades at about 15 times earnings, which for a business that's been a roll-up specialist for quite some time. And all in all, I mean, maybe there was a few duds here and there, but returns on capital have been okay. It's not like the business is completely crippled by what it has done and is in too much of a debt kind of situation. It's basically going through a modest restructuring of the business, as well as trying to wring out about $85 to $90 million in annualized expenses by doing things like consolidating some of its business lines into, single offices, things like that. Again, this isn't exactly like what I would call a knock it out of the park kind of business. It's health and beauty products are probably going to grow single digits, maybe once they get things turned around. It's outdoor products, so water bottles, clothing line, things like that, they can expect to maybe get into the high single digits range. But if you can kind of get this thing back into like cross control, get your inventory under control, and a lot of the other issues that other product companies have seen over the couple of years with managing inventory, managing supply chains so much over this, past 3 years, has just been one of the, you can't name a consumer products company or an industrial company that hasn't had some sort of supply chain or inventory issue at one point or another. And this was just one of the ones that got hit harder than normal. So all of that said, it's kind of middle of the road right now. It's still throwing off a lot of cash and has been using that to pay down some debt, try to get its financial house in order a little bit better. It's to the point where I'm looking at this at 15 times earnings, 1.6 times book value. It looks intriguing at this point, and it's certainly I want to dig a little bit deeper. It's they're still having some issues with inventory. They're still having issues with kind of sales, which is kind of expected. But if it can start to show some tangible progress on things like winding down some inventory, improving cash conversion cycles, basically, turning over product at a steadier rate, we could see an uptick in profitability. And I think that could do a lot for this company. It was a victim of a short report, which is kind of one of the reasons why it's down 50%. And arguably, a lot of the things that were said in it were probably justified. But if they have a new CEO that just started on March 1st, she was the former chief operating officer. And like I said, if we can just kind of do the blocking and tackling of a normal consumer product business, there could be some real value here.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.